This analysis report lays out a strong contrarian case for Strive Inc., ASST, arguing the current 90-cent price is just wrong, given its pivot to a Bitcoin treasury company.
It's a very convicted take.
It is. So let's dive right in and see how we can make this argument that Wall Street is wrong about ASST even stronger. The foundation here, it's obviously the MicroStrategy comparison. It makes a really forceful case that ASST is a brand new company.
Right. A highly capitalized Bitcoin beta play, especially after that huge $750 million raise.
And the report is decisive. It says the market is just stuck looking at the old failed tech company.
That structural shift is the core strength, absolutely. But here's where I think we can add a lot more power.
Okay.
Bitcoin treasury model with the established Strive asset management business.
Right, I noticed that. The asset management arm, the roughly $2 billion in assets under management, it's mentioned, but it feels like a footnote.
That's the weakness right there. It's an afterthought. And by just briefly mentioning it, the report kind of undervalues this whole other engine inside the company.
So it frames ASST as just another pure holding company.
Exactly, just like MicroStrategy was. But the thing is, if AST is only a Bitcoin beta play, then it's just tied to pure volatility. It misses this critical differentiator. The AUM component is a distinct, non-Bitcoin correlated revenue source.
So that $2 billion business isn't just a side note, it's a structural advantage. How do we integrate that to make the argument, unique?
The suggestion for improvement is to weave that asset management piece right into the core thesis, robustly. We need to explain how the AUM provides this vital stabilizing element.
A stabilizer.
Think about it. A pure Bitcoin treasury company is a risk vehicle, period. ASST, though, has this internal mechanism that generates predictable fee revenue. That could offset costs, provide a fundamental revenue floor. It just makes the whole structure more robust.
Especially during a big Bitcoin drawdown.
For sure, that's a powerful differentiator.
It means the ASST structure has downside mitigation that MSTR, doesn't inherently have. We're not just arguing for a smaller copycat, we're arguing for a potentially superior risk-adjusted structure.
I like that. A superior structure.
Exactly. And the report needs to quantify that. For concrete examples, you could suggest modeling a high-level scenario. Show how recurring fee revenue from that $2 billion in AUM could sustain operations. That decreases the reliance on pure capital appreciation just to keep the lights on. It's an internal shield.
And in the valuation section, how does that carry over?
Well, in the valuation gap part of the report, you could suggest a rough calculation. Estimate the recurring earnings power of the asset management firm.
Okay.
And then present that as the fundamental floor of the enterprise value. Then you layer the Bitcoin treasury value on top. It presents two distinct but synergistic components, making the case for a higher baseline valuation much, much clearer.
That structural clarity is key. It tells a sophisticated investor the 90-cent price is wrong, not just because of Bitcoin, but because the market is ignoring a whole other proven business bolted onto it.
Yep.
Which leads us right to the valuation segment. This is where things get a little tricky. The report does a great job debunking the penny stock idea.
It does.
Citing the $750 million raise, the new market cap, it identifies the market failure perfectly. But
There's a but.
there's a logical tension here we have to resolve. To really secure the argument that the 90-cent price is just a psychological discount, the analysis must resolve the tension between dismissing the old business structure while still relying on its historic volatility metrics.
What's the specific contradiction you're seeing? The one that could undermine this clean break narrative. The weakness is that the conclusion uses the 52-week high of $13.40.
Right.
But that price was established under the previous failed business structure.
Right.
If the whole point is that the old business is irrelevant and Wall Street's looking in the rearview mirror,
Then using a number from that rearview mirror weakens the argument.
it completely weakens the narrative that this is an entirely new situation.
But wait, isn't referencing the 1340 high helpful for psychology? You need a big number to show the scale of the opportunity, especially for momentum investors.
It's helpful for momentum, I agree, but it's detrimental to credibility. It creates a contradiction that any skeptical institutional reader will jump on immediately.
So what's the fix?
The suggestion is to focus the valuation discussion exclusively on the new capital structure. Calculate the implied net asset value, the NAV per share. Base it on the recently raised cash and Bitcoin. That gives you a clean, defensible, forward-looking floor. It's a much stronger foundation.
So we establish a new baseline, one that's derived purely from the current balance sheet, which is what an investor is actually buying today.
Precisely. We're building the argument on present facts, not past market euphoria. For a concrete example, instead of that old 1340 high, Just calculate the theoretical current NAV per share. You have the market cap, you have the $750 million in new cash and Bitcoin.
That gives you a clean, undeniable baseline to compare against 90 cents.
Yes. And it also helps solidify the argument around that $1.50 target from Maxim Group.
How so?
You frame that 150 target not just as a 66% upside number. You frame it as a valuation derived from comparing the new ASST balance sheet leverage ratio to MicroStrategy's. It grounds the future potential in the present financial facts.
It gives the valuation a structural anchor, not just a technical one.
That's the key.
Okay, that addresses the downside protection and the structural target. Let's talk about what triggers the upside. The report has two powerful drivers, the long-term Bitcoin play and the very immediate technical short squeeze setup.
I agree they're both powerful, but they feel like two separate plays, which I think is a structural weakness. The analysis report should more cohesively merge its short-term catalysts, specifically that short squeeze, with the long-term investment thesis.
Right now it presents Catalyst 1, the Bitcoin beta play, and Catalyst 2, the short squeeze, as these.
Distinct drivers that just happen to be occurring at the same time.
And that's the weakness. When you present them separately, you risk appealing only to a short-term trader, someone who might just exit after the initial pop.
Instead of the durable long-term investor.
Exactly. You want to avoid framing this as just a quick trade, especially if the real intent is to show that Wall Street is fundamentally wrong about the company's long-term value.
But if the squeeze is successful, won't it just attract day traders? How do you make sure the narrative sticks around long enough for the fundamental guys to step in?
That is the core of the improvement. The suggestion is to frame the short squeeze not just as a quick pop, but as the essential, necessary mechanism that forces the market to permanently re-rate AST.
It's the thing that activates that long-term leveraged Bitcoin beta multiple the report already identified.
So the technical setup serves the fundamental purpose. We need to make that connection crystal clear.
Absolutely. For concrete examples, you should integrate the technical levels, the 80-cent support, the 90-cent close, that 92 to 95-cent breakout range, directly into the short thesis narrative.
How would that sound?
You could detail how a clean, sustained break above 95 cents does two things at once. It confirms buyer confidence, and it simultaneously triggers forced short covering. That forced covering is what locks in the initial move toward that conservative $1.15 technical target.
So the technical resistance levels are really just proxies for where the shorts are trapped. You're turning a short covering floor into a new fundamental floor. The whole narrative becomes seamless.
And the conclusion to that section has to reinforce the permanence of this shift, suggest explaining that once that big short interest, 15%, once that's forced to cover, the stock settles at a new, much higher baseline.
It doesn't just fall back to 90 cents.
Exactly. It settles at a valuation that reflects the company's true asset holdings and the Bitcoin beta multiple. The squeeze permanently alters the market's perception.
That was a highly focused critique on a really bold analysis. It's incredible how one small logical flaw, like using that old high, can almost derail such a high conviction thesis.